Today, we tackle a portfolio protection and retirement income strategy that, despite the empirical research behind it, remains one of the most polarizing financial topics outside of the discussion of annuities. That's the tactical use of reverse mortgages. Among the most strategic of those uses is to give your portfolio a breather when market declines are giving it a beatdown, and temporarily turn to tax-free income from the equity in your home to tide you over. Stay tuned as we discuss this and other creative ways to use this financial tool, as well as some of the risks, right now on the Retirement Lifestyle Show. Welcome to the Retirement Lifestyle Show. I'm Erik Olson, joined today by one of my co-hosts, Adrian Nicholson. Roshan Lungani is in his books and learning today, focused on learning more about value investing. That I love that guy's intensity about learning. But he's not going to be with us today. So, Adrian, you and I can beat him up a little bit as we talk about this or that. Sound good?
Sounds good, Erik, but I'm really curious to hear what Roshan is going to get from this value conference as well. I'm really excited to see if he's got any tips for us or any new ideas. So I'm really looking forward to that conversation.
Yes, I am too. And you're much more gentlemanly about it than I am. So yeah, Roshan, when you listen to this, we're looking forward to hearing what you had to learn yourself. So today, folks, the topic is one that I think is long overdue for the Retirement Lifestyle Show to have addressed. And let me start not with the topic. Instead, let me start with the challenge that retirees will often face, not always, but oftentimes they'll face in trying to make sure that the math of retirement and the math of retirement income works for them. And so we talk about a host of different ways of making a retirement portfolio, as well as any sorts of guaranteed income sources like pensions or Social Security to stretch farther. For example, we've spent a lot of time talking about things like the sequence of withdrawals, or Roth conversions, or optimizing the choice of when to claim Social Security, or where to put different parts of your portfolio into different tax classification categories, such as IRAs, which are tax deferred, or Roth IRAs, which are tax free, or taxable accounts, which is taxed as the name implies as you go. But there are other techniques that fall outside strictly those realms of the pure investment portfolio or the claiming strategy on guaranteed income that we haven't spent as much time talking about. So what I want to talk with you about today, or what we want to talk with you about today, is what if we could provide you a solution that would take, let's say that you're early 60s and that you have a $500,000 home and you have $1 million portfolio and you have, I don't know, $50,000 of guaranteed income from Social Security and no pension. And now you're trying to figure out, how could I make this work? If there were a way that we could show you that might add $100,000, $150,000, or $200,000 of terminal value to your portfolio and make you therefore more secure from an income standpoint along that journey, would that be of interest to you? Well, we hope so. We hope that's one main reason that you listen to the Retirement Lifestyle Show. So today that topic is, and some of you, as soon as I say these following two words, you're going to react. You're going to change the channel on your car radio. Of course, we're not on radio, but you're going to switch to the next podcast in your podcast feed or whatever the case might be. But I'm going to ask you to not allow sort of your prejudice about this sort of thing to derail you from listening and learning today, or if you're one of our YouTube audience members watching what we have to say here. And no, the word isn't annuities. So you ready for the word? Adrian, have I built this up long enough? Do you think I can go ahead and spill the beans?
Yes, go ahead, Erik.
Okay. So it is. Actually, Adrian, why don't you spill the beans? What are we talking about today?
Today, we're going to be talking about reverse mortgage.
Oh, horror, shocker. No, you can't have gone to the dark side, Adrian and Erik. Come on. Why are we talking about this? So, Adrian, define, first of all, what is a reverse mortgage?
And I got to imagine some people just draw back when they hear this, because the very basic definition of a reverse mortgage, it's a loan. So some people may not like that idea right away that it's a loan. Well, a reverse mortgage is a loan, but it can get you access to the equity that you built up in your home. This allows borrowers to receive payments or a one-time payment based on the value of their home. And this is a way where they can just have income coming in the door, an alternative option other than the ones that Erik mentioned before in the beginning of the podcast. So again, it's a loan that helps you tap into the equity that you built into your home, and you can receive payments in all different ways. One of the most common examples of a reverse mortgage is the home equity conversion mortgage, which is insured by the Federal Housing Administration. This is a non-recourse loan, which means it's collateral based on the home that you have. You're getting these monthly payments because you have equity built up in this home. So this is an alternative way for some people to receive payment in retirement. And
Adrian,
this is, yep, go ahead,
one
Erik.
second, because you used a term I think maybe some people are not entirely sure what to make of. You used the term non-recourse loan. What does that mean?
So this, again, it's a form of collateral where when the home is sold, this is more of an insurance where you don't have to cover the difference. This insurance that you have, this loan, will cover the difference on the sale price and what you own for the loan. You want to dig
So
a little bit deeper into that, Erik?
yeah, I will just say, so let's use the scenario where I pass away before I have gone upside down in the home. Upside down means that the home is worth less than the balance of the mortgage has grown to become in this reverse mortgage situation. In that case, I'm underwater. What can they not do to make themselves whole in that case?
For example, one thing I need to point out in the definition is when you have to pay this loan back. And you have to pay this loan back when you move, sell the home, or the person that has the loan passes away. So I just wanted to make note of that.
All right. So, but in which is true. And at the point that you sell the home, if you've passed away, and you're now underwater in the home, some people say, well, won't they though go raid the rest of my assets to make up the difference? And the answer is no. That's why it's a non-recourse loan.
Exactly.
In other words, they can't go after other assets to make themselves whole if you beat the odds for your age cohort and lived a really long time, continuing to receive the ongoing payments that are available there, or took a lump sum and the balance of that with the principal growing on it continued to grow. So the non-recourse feature is a very powerful protection for the borrower. All right, I interrupted you. You were in the midst of talking about one of the various forms was the HECM, as it's called, and that it's a non-recourse loan. You had other types, though.
Yes, the other type is a proprietary reverse mortgage. This is without that government guarantee that the FHA has. And this has loosened eligibility requirements, but it typically tends to have higher fees. But the similar definitions come over with each other on this one as well. The next one is a home equity conversion mortgage for purchase. This is when somebody wants to buy a new home for their primary residence, where they'll use the balance of the purchase with the reverse mortgage rather than paying with a cash or a standard mortgage. And the last one is a single purpose reverse mortgage. This is where you have more restrictions on what you can use with the money you're receiving with this reverse mortgage as well. So those are the different types of reverse mortgages that are out there. But the concept is really the same. You're really receiving payments based on the equity and the home value that you currently have.
All right. And so some listeners may be saying, wait a second, why would anybody do the second one of those? Why, if you're going to be faced with higher fees, why would you go to a proprietary loan as opposed to just using one that's FHA backed, where you get all of those other benefits, lower fees, non-recourse? Who in the world would be drawn potentially to that type of the proprietary version?
So I got to imagine one of the biggest drawbacks to this, again, like we mentioned for the proprietary one, is the higher fees. But again, mentioning it, it has loosened eligibility requirements. So if there's a certain lender or certain ones that you don't qualify for, this may give you that opportunity.
And one other thing is that some people will say, hey, the limits that are imposed on the upper limits on how much can be lent out under the more conventional FHA backed HECM or the reverse mortgage, those limits aren't in place. So let's say you have, I think it's somewhere in the mid 800s now, I think is where it is.
Mm-hmm.
So if your home is greater than $800,000, and once upon a time we'd say, okay, how many homes are above 800,000? Boy, if you live in San Diego and you live in a modest home, probably your home in San Diego. If you live, I'm using just one place that I'm familiar with, and there's lots of cities now where home prices have reached levels where it's not uncommon at all to have a home that's well above that 800 or mid 800 level. So on that basis, you may say, hey, we really would benefit from having more capacity here. Let's go ahead and suck up the additional expense involved in the proprietary version in order to have a larger balance that we would be eligible for.
Mm-hmm. Yeah, and
And
exactly. And then going back to the HECM loan, there's also something that people need to make note of as well, if this is something that you're considering, is that you're still also going to be responsible for property taxes, homeowner insurance, repairs, and certain maintenance as well. So that's also something you really have to consider if this monthly payment or one-time payment you're going to be receiving is something that you can keep up with in a way when you have all these other costs associated with being a homeowner.
mm-hmm. So, listeners, of what we wanted to do today was to tell you a story of an actual client case and illustrate one way in which the home equity or the reverse mortgage could be used, and then talk about other applications of this technique. Because you may hear the first story and say, "Well, that doesn't apply to me. Why I'm not interested now." But just sit tight, because there are various creative ways in which you can use this, and some of you may also be thinking, well, wait, I'm still, it's so early in my tenure here. I may consider this, but I'm in no need to consider this now. I'm going to go to the next episode in my podcast feed. Sit tight there too. If you are approaching 60 or you're actually in your early 60s, but have no intention whatsoever of even contemplating this for another 20 years, I'm going to actually share with you a reason that you might want to reconsider initiating but not borrowing from a reverse mortgage. We'll come back to that in a little bit. So let me first tell you the story. And this, all stories have only so many applications here, and I'll build on the elements of this story in just a moment. But so I have actually a delightful couple, no longer a couple though, that reached a point in their long marriage where they felt, this is just not going to continue. We can't continue this way. And so they had to figure out what they were going to do to divide their assets as part of their now going their separate ways. Well, one of the things that they owned together was a fully paid home, which was, beautiful home. At this point, this is a little prior to some of the price appreciation that we've seen here since COVID. But at that point, this was a $300,000 home in a nice neighborhood and so forth. And they figured, okay, how do we split this? Well, one of the two wanted it to move away, but one of them wanted to stay in that community. And so what they did was um, determined how much of the home's value they thought each one was responsible for, or what value would be attributable to each of them. And it wasn't a 50-50 split for reasons I won't get into. So what the person who wanted to stay in the home did was went and didn't, because this person did not have the resources to just come up with the cash and pay out that part of the value of the home to the other member of this divorce. And so thought, how am I going to do this? I could go borrow and do a cash out refi on this, but because for other reasons, this person had already retired. I'm not exactly, a glowingly strong candidate for getting a new mortgage, given the fact that I'm no longer working and my income is therefore more limited. So instead, what this person did was to get a reverse mortgage. And that reverse mortgage was structured in such a way, and we looked around for various lenders and what their interest rates were and what their terms were. And after my team looking through, I would say, I think it was about 7 or 8 different lenders for this client. And by the way, we had no financial stake in this. We don't do reverse mortgages. We were just trying to help are a client match with somebody who would take good care of them. In this case, what we found was a lender who was offering a fixed rate mortgage for a $90,000 payout from this $300,000 home that the person who would remain in this home could then pay to his divorcing spouse. And then on top of that, there was enough additional equity left in the home that on top of that distribution, so it went from, now the equity went from 300,000 to 210, but there was still enough equity in the home that we could take it one step further. And that was to have distributions from that reverse mortgage cover not only the property taxes, but also the homeowner's insurance in perpetuity for this client. Oh, and also the homeowners association fee. So effectively, the person who stayed in the home was able, in this case, then to stay in the neighborhood that this client loved so much, and keep those relationships intact, but now bring their real cost of remaining in the home to effectively zero on a day-to-day basis or month-to-month basis. Although it didn't mean that this client would be responsible for those periodic home repairs, new roof, new furnace, new air conditioner, all of that stuff. As it arose, this client would need to cover those costs. But in this way, the client felt like, obviously devastated by the divorce, but at least at the level of the home, was delighted that the client could stay in the home and retain those relationships, keep that network of relationships intact, and lower the overall month-to-month cost of living.
Mm-hmm. That's great. That's the perfect example, really, because in this situation, they were really able to maintain their lifestyle still without making any drastic changes. And they're also an example like this. Some people might be forced to withdraw or pull from various accounts just to figure out how to maintain this. So it seems like a really smooth process, again, to really help maintain their lifestyle, which is really important, especially in a situation like that where they're going through a difficult period in their life, where you're structuring whatever their situation is in a way to maintain what they want to have moving forward. So that is a really big benefit here to this topic.
So here, our dear listeners, we want to outline some ways in which you could use this, if it isn't already somewhat obvious from, or at least some of them somewhat obvious from the story that I just told. So one way in which you can use a reverse mortgage is you need a lump sum now. And that could be for any number of possible purposes, one of which, is Adrian indicated earlier, is to go buy a second place.
Mm-hmm.
The second is that you can have a stream of income that starts now. And that stream of income can be for a certain period of time, or it can be for an indefinite period of time. Obviously, if you say it's going to be for a certain period of time and not indefinite, they will give you more per month during that certain period of time. Who might consider something like that? Well, I know that a lot of my clients are saying, Eric, come on. You're telling me you're going to make me wait on Social Security till 70, which is not true in every case, but in many cases, the answer is yes. I paid into it. I'm not sure it's going to be there. I want to get the benefit out of it. Who knows how long I'm going to live, et cetera, et cetera. And I'm not poking fun at you if you think that way. It's just, but that is a common conversation with some clients. So one way of addressing that is to say, what if we then said, you're 62. What if we put together an 8-year payout from a reverse mortgage? And that way you'll have that income stream that will get started now, but you'll do yourself a big favor by having what would be at age 70, a monthly payment that would be roughly 80% higher per month after all the inflation adjustments are considered than what you would have it at 70 if you started your Social Security at 62. You could use some of that surplus actually starting at age 70 and repay the mortgage if you wish to, the reverse mortgage that you've taken out, or you may not want to. There's not a one size fits all answer for that. But for somebody who's feeling stressed about that particular question, this is a way that they can do that. And by the way, this approach doesn't have the element that the Social Security payments do if you start at 62 and so forth, all the way up to your full retirement age, where if you go out and said, you know what, I'm kind of like to do some part-time work. If you do enough of that part-time work or some consulting or whatever, it essentially reduces the amount that you'd be taking from Social Security anyway. So on this basis, that short-term application but it's an income stream that starts now. That's another application. A third application of this is to use this to open the arrangement or open the relationship so that it's formally established that you have access to a credit line, but you don't actually take any money from the home yet. And you may not know if there will ever come a time when you will take money from the home. But if you get into a position where you do need it, then you're in a position to go about that. So, what might be an example of that? It might be that, and I think this is not an uncommon one today, as you've been looking perhaps at where long-term care insurance or long-term care costs themselves, not the insurance costs, but the cost of care is going. You may say, I don't know if I'm going to be one of those that is needing some form of care for some period of time as I get older. But if I do, then this would be a way to either augment insurance or to potentially replace long-term care insurance and use the equity in my home to cover some portion of those costs. But I don't have to do that until later. So some of you, I could imagine, are saying, well, Erik, if this is all about later, why don't I just wait until later to see if I need to do that? And at that point, I can at that point open up this reverse mortgage. Well, I'll come back to that after I give you one or two more scenarios here, because there is actually a very good answer. So in addition, another approach, rather than saying I will use it probably at the final stages of my life for long-term care costs, instead, you could use it on an episodic basis throughout your life when something arises. What are some things that I think of and this comes back to what I said in the very beginning of our show today, which is how, if we could show you a way that might leave you with actually greater terminal net worth and make your retirement income more confident, would you be interested in that? Well, one way in which you could use this is when you have a really difficult year in the markets, as we've talked about many, many times, it doesn't help your portfolio to take out your usual, whatever X number of dollars, if it's $40,000 a year or $80,000 a year or whatever number you're taking out of your portfolio. It doesn't help your portfolio's ability to kind of rejuvenate itself if you peel it down in a down year by that same amount. You might want to go easy in a down year. In fact, you might want to just say, I'm gonna not take anything out of the portfolio in a down year. But then you're scratching your head saying, well, but if I don't take anything out of the portfolio in a down year, where's the money supposed to come from? Aha. This is where that reverse mortgage optionality comes into play, where you could at that point then say, I'm going to just do that this year. And then as markets recover, or maybe it's for 2 or 3 years, but as markets recover, then the portfolio will be in a much stronger place where it can repay that amount that I took out. And so that it's essentially acting as a capacitor. If any of you remember from your electronics class back in high school, the concept of where you keep some, or a reservoir, maybe that's a more recognizable term, a reservoir where you're the water's there when you have a drought that you can call upon. And so this, some of you are saying, well, Erik's there again. I'm puzzled. Why are you suggesting that I consider opening it earlier if I could just wait until that down year to open it? And the answer is that if you get it started earlier, given the structure, the statutory framework in which reverse mortgages work, as time progresses from the point at which you open it, not from the point in time you use it, but from the point in time you open it, the allowable amount that you can borrow expands. And so if you said, I'm going to open it at 62, let's say, but I don't anticipate using it for the indefinite future, and maybe the first time you do use it is when you're 72 for a year, and then 87 for a year, and whatever the case might be, in those instances, the amount that you would have available to borrow would be all else being equal, would be larger than the amount that you would have available if you waited until 72 or you waited till 87 to open it. So, in other words, the bottom line is that whether it's money that you're going to take now as a lump sum, money that you're going to start now as an income stream, or money that you're going to use and you're going to take as a lump sum in the future, or take as an income stream in the future, or take as a periodic replacement from portfolio withdrawals at points you can't yet predict. Any of those approaches is available to you, but the latter three, getting it started as a formal arrangement earlier can help you have more flexibility later on.
And flexibility is such a great thing to have, just options. And I just like how you can really just structure this in a way that suits you best. And I think that's always really helpful when it comes to receiving any type of income, whatever your situation is. It's not like you're locked into a specific one. You can find one that fits your needs.
Mm-hmm. So I want to talk about one more consideration in all this, and then Adrian, I know you did some good homework on the pros and cons of using this, and then can share with our listeners exactly how they're saying, oh, enough already. We're ready to go have a conversation with somebody about doing a reverse mortgage. Then you'll have some information for our listeners as to how they might go about that.
Yes.
But I just want to say, because I started this by, again, saying, hey, what if we could show you a way that would extend the life and the survivability and the durability of your portfolio? And this concept of taking those withdrawals during years in which the markets are challenged and using, I should say, withdrawals from the reverse mortgage rather than from the portfolio itself, that can elongate the portfolio. And some of you are rightly asking, but yes, Eric, if I'm taking money out in those years, as you've just suggested, there is an interest cost on those. And now I'm going to be saddled with that interest cost for years and years and years. That's true. If you don't pay it back, that is true. But even the modeling that I've seen done on this, and the person that I would just point to, all of you to consider looking at this more closely, is Wade Pfau. Wade is, his last name is spelled Pfau, and he is one of the most advanced researchers on this subject. In fact, even this year, he has updated his book on this subject, which he first released in 2016. It is on reverse mortgages, so you can go and find it your favorite bookseller. The copy of the 2023 version of his reverse mortgage book, but in there he'll get into greater detail about this, and you'll see more of it. But the nutshell version is, despite those interest costs being saddled with it, a properly allocated portfolio probably outpaces the growth of the debt obligation, and as a result, yes, the portfolio grows more because it wasn't damaged as much. The balance of that reverse mortgage also is growing, but the net of that is that, at least in most of the modeling he's done, the terminal value of the portfolio after subtracting the balance of the reverse mortgage leaves you in a better spot, and that's what we're looking for. But I'll say one other thing that his model, in that instance at least, doesn't assume, and you might want to take this approach. If you thought about this, why do most people hold bonds in their portfolios? I think most people hold bonds in their portfolios because they think that there's some income coming from them, but they also think about the value of bonds to suppress volatility. Well, if you thought differently about the totality of your allocation that's available for your support, and thought about the allocation to equity in your home as another form of resources that's available to you, which is it more like? Is equity in your home more like a stock with its volatility patterns and its growth patterns, or is it more like a bond with its more subdued volatility and its lower overall total return? I think most of us would agree it's more like the latter, not the former. And so if you thought that way, you might say, oh, okay, with that equity as part of the overall equation, or the equity in my home, but that equity in my home behaving more like a bond than like a stock, maybe what I could do to have a balanced portfolio is to take the actual assets that I have invested in public markets as opposed to in the home, and tilt the balance of those somewhat away from bonds, now thinking of my home as a bond, and more toward equities. What's the outcome of that? Well, there's certainly a little more volatility in it, no doubt. But long run, if history is any guide, I mean, we're talking about hundreds of years of history now, so I don't think I'm in danger of. I'm certainly in danger in the short term of being contradicted, but I don't think over the next, let's say, 2 or 3 decades, I'm in danger of being contradicted. I think it would be safe to say that odds are the equity portion of that portfolio, therefore, would build your overall portfolio value larger, especially if you weren't tapping into that portfolio for income during down years.
That is great, Eric. I mean, I really liked some of those examples that you brought up, and I just wanted to go over a few more that I have on my list. I broke it down into a pros and cons list just so people can have a better understanding what are some of the benefits and what are some of the drawbacks to having a reverse mortgage. So I'll just start off with the pros, and a big one that people probably have a question about or might consider what are some of the tax implications when it comes to having a reverse mortgage and receiving these payments. Well, since the IRS considers this a loan, the payments that you are receiving are not taxable. So that's a really interesting thing if you're very tax efficient when it comes to planning. This is something that can really benefit you in the long run where you're receiving an income in the door that's not being taxed, especially if you're in those higher brackets. This is a really big benefit. And Eric, I know you're really big when it comes to tax efficient planning. So this is right up your avenue.
Mm-hmm.
And then another big thing that people also are going to be considering is since this is not taxable with these monthly payments coming in, I guess people are thinking, how is my Social Security or my Medicare benefits going to be impacted by this? Well, the short answer, it's not going to be impacted as well. So that's also another big benefit to receiving income. This isn't going to impact your Social Security or your Medicare benefits. The next pro I have on my list is something that we already touched on and discussed, how this really does give you greater options and flexibilities when it comes to receiving income. You can structure it in a way that suits you best. If you want a one-time payment, you can do the lump sum. If you want to structure it in a form of a line of credit, you can do that. If you want to have it monthly payments spread out, you can do that as well. The only thing you just have to be aware of is you can only receive these payments as long as this is your primary residence. So structuring payments in a way that suits you best is always really great to maintain whatever lifestyle you have. So that's something that can really benefit you with having a reverse mortgage, just that greater degree of flexibility. And my last pro on my list is reverse mortgages really do benefit people that see if their home is a forever home. Where if you're in this home for a short period of time, a reverse mortgage really doesn't benefit you in this way because it has to be your primary residence. So Eric, do you want to comment or look at any of those pros I just listed before I got into the cons?
No, I think that's a great list, actually. And I love the fact that you highlighted the tax-free component. So there may actually be years in which you would say it'd be advantageous to take funds from that rather than if there's a big expense that you had in a certain year, rather than taking more money, let's say, out of an IRA, if you were already right at the boundary line of a tax bracket, or even potentially in some cases worse, you were right at the boundary of a Medicare surcharge boundary. Yeah, you
Exactly.
might want to take this money out tax free and then not jeopardize, not drive it into a higher tax bracket or not force yourself a couple years later to be in a higher Medicaid Part B or Part D surcharge zone.
Exactly. And now we're going to move on to the con list. And the biggest one that me and Eric kind of agreed was the big one when we were getting ready for this podcast is the cost of a reverse mortgage. It's not free to do. There are a lot of things that you need to consider as far as costs, which are mortgage insurance, there's closing costs, origination fees, servicing fees, and these can add up over time. So this is where you really need to really dig into the numbers and really see what monthly payment or payment is best for you. And is it really worth it in the long run when you're going to get hit with all these fees with creating and going forward with a reverse mortgage? So that's something that you really need to consider.
Mhm.
My next con on my list is, and this is something that's a risk for everybody really as they get older, is if you are in a situation where you're forced to leave your home and this is no longer your primary residence. And as we discussed before with the definition of reverse mortgage, this has to be your primary residence. And if you move or you sell the property, or in this case, you're forced to leave and go to a long term care facility, you'll may be at risk of paying the loan back. And I think that's a big one. What do you think, Eric?
Oh yeah, if you do, as you said, want to be sure that this is a long, long time. You intend to be in this home for a long period. Now, I would say, or at least a long enough period where the the advantages that we've already talked about, other than the ways in which you can use it, you actually could use. There certainly would be some cases in which our clients might be listening, and listeners would be saying, well, wait a second. If you're Eric, if the argument was that you were making earlier is that I should consider making withdrawals from this during the years in which the market has really dealt a blow to my portfolio, but when my portfolio springs back to life, then I could go ahead and repay the amount that I took out in the prior year. I don't think I necessarily need to be in that home forever, do I? And the answer is you're right, you don't. In that case, you're not going to have that mounting reverse mortgage debt. So, but just think about the applications that you're intending to consider as your primary motives for looking at this approach.
Hmm. Exactly. And then the last con on my list is what you have to consider from an affordability standpoint when it comes to paying off the loan, whether you're moving or you're selling, or in this case, if somebody passes away, what is your estate going to be when it comes to the affordability standpoint, especially if it's not the non-recourse loan that we talked about before. Having to cover the costs and losing this house is something that you really just need to have a conversation with if this situation arises.
Mm-hmm. Yeah, if you're thinking about relocating, obviously, then you might want to just say, well, let's just make sure that there's enough in reserve to cover the cost of whatever. When I sell the house, assuming I'm not underwater, I'll
Hmm.
have some sort of equity proceeds from the home. Those will be less than the equity proceeds that I would otherwise have if I didn't take out the reverse mortgage. No doubt. So just model A and B, and then look at, well, okay, if I then did have the proceeds from the sale of that home at that latter stage that were lesser as a result of this, then what could I, conceivably buy? And you remember to build into that analysis some allowance for ongoing price appreciation in the homes that you're wanting to purchase, not just in the one that you'd want to sell. So, as we've talked about before, over long, long periods of time, um, the inflation rate in this country has been about 3.5%. And if you look at housing, it's similarly tied to disposable household income, because obviously people can't pay more than they're actually earning on a shelter or a dwelling. So on that basis, if it's roughly going to be a long run rate of 3.5 or 4% per year, then just project out that presumably, let's just use a number here now, that $400,000 home that you might be considering purchasing in 20 years, if indeed inflation does proceed at the pace that we've talked about, 3.5% or so, then that home won't be a $400,000 home. 20 years out, it'll be more like possibly an $800,000 home, something in that neighborhood.
Hmm. Exactly. So those are all things you have to really consider when it comes to whether or not this reverse mortgage is right or not for you, just outweighing the pros and cons. So I just wanted
Mm-hmm.
to go through that list.
Mm-hmm. Yeah, that's a good list. So people might be wondering, okay, I'm not entirely sold here, guys, but at least as you promised at the outset, I'm a little bit more open-minded. I'm glad I didn't go to the next episode in my feed. So how would they learn more about how to go about actually doing this? What are the mechanics, Adrian?
So first things first, you got to see if you meet the qualifications on it, because not everybody can do it. So you generally have to have some sufficient equity build up into your home. And typically, you can get a reverse mortgage on a single family dwelling, but sometimes there are cases where you are able to get a reverse mortgage on a multi-family structure. You just really have to look to see if you meet these certain criterias as well. There's also an age component too, as well. You have to be 62 or older But in this case, if there's multiple people on the property, it's the youngest has to be 62 or older. So that's another factor that you really need to consider. And the biggest one as well, this has to be your primary residence.
Yeah. Well, thanks for that. So, Adrian, did you have any other resources to which you wanted to point our listeners?
So one thing also that people should also consider in looking at is when it comes to applying to a reverse mortgage, you do have to attend what they call a counseling session and receive a certification as well, where they go over what we're going over today, the certain workings and ins and outs of how a reverse mortgage works. And you have to see what type of lender that you can work with, what suits you best, where they'll go over certain things like your financial information. They'll go over certain taxes, insurance, and just see how this will fit in your overall plan. And then, of course, finding out what payout method works best for you. Those are basically the ins and outs when it comes to applying for the reverse mortgage.
Mm-hmm. Great. Yeah, I want to point people to a few other resources as well. So one is the Wharton School, which is at the University of Pennsylvania, has a center. I think it's Sam Zell and I'm drawing a blank on his first name, Lurie, but it's the Center for Real Estate. And at that center, one of the things that they've done is a number of working papers over the years on various aspects of real estate usage, and there's been a number of working papers that they've done on reverse mortgages. So I would encourage you to go explore some of those. I've already mentioned Wade Pfau. I'm going to mention one other, although I hesitate to do this a little bit. I'm just going to say, make sure that you have your antivirus updated and you have your VPN on, perhaps. I just want to, any sorts of things that you can use, I think, to safeguard yourself on this one, because it's not a secure website. I don't know why, but one of the earlier members of the I think it's at Wharton again, was a fellow named, and still is, Professor Gutentag, who's now, I believe, an emeritus professor of finance there. And his concerns, he was actually wrote some of those white papers that I just referenced a minute ago. So, but his concern about the way in which the market for reverse mortgages actually functions, and the extent to which many seniors in particular don't have good information about where to find these and how to compare these sorts of things. He created something called the Mortgage Professor. And so you could go look at his website, the Mortgage Professor. It has a number of really interesting tables and some calculators and some cost comparison tools. He was part of a group that developed, this is again at Wharton, something that they called the kosher HECM, or the kosher reverse mortgage. What do they mean by that? Specifically, it's a design that where participating providers of reverse mortgages agree to some cost reductions on the underlying features of all that. So origination fees are considerably lower, as an example. And with that, then the overall benefit tilts even further in the favor of the borrower. So you could explore the concept of a kosher mortgage. Finally, if you're thinking, well, listen, I don't have the time to do all of that research, then you can just go to our website, retirementlifestyleshow.com. You'll find Adrian's, Roshan's, and my contact information there. Just send us an email, or pick up the phone and give us a ring and tell us what it is that you're trying to accomplish, and maybe there's a way in which we can work together to help you sort through some of that. So this is what we're here to do, is to help people, and so that's the nature of what we do day in and day out. So don't hesitate to reach out to us. Anything that you'd add to that, Adrian?
No, thanks for sharing those resources, Eric, though I'm sure they're going to be extremely helpful for our viewers and our listeners. And I really enjoyed discussing this topic today. I see a lot of great benefits. I also see why some people critique this as well and don't think it's right for them. But again, that's the whole purpose of why we're having this discussion today, just to help our listeners and viewers to consider what's out there to help them improve their overall financial well-being when it comes to retirement.
Mm-hmm. So true. Well, listeners, we hasten to add here at the end of the episode, just as we introduced at the top of the episode, that this is just one of numerous possible strategies. It's not that we are fanboys of reverse mortgages per se. What we are is fanboys of creative ways of helping you succeed, and particularly helping you succeed on one of the biggest financial decisions that you'll ever make, or financial challenges that you'll ever face, which is funding a retirement where you're no longer earning a paycheck. And that's where we devote a lot of energies to all of this. Having said all of this, I just want to also issue the disclaimer that don't please take anything that we've said today as specific advice for your situation. This is instead, these are principles. We're trying to be educational and broad about this. So if you're thinking if this one or the other of these ideas applies specifically to you, do seek out advice from a professional. And if you don't have someone that you trust in that way, again, reach out to us. Last thing I'll say is, if you value this show, if you've listened this deep into it, it appears that you at least value this episode, we'd ask you to go to your favorite podcast player, or if you're watching us on YouTube, to go ahead and give us a review, give us a rating. 5 stars will help us a lot. It does actually help other people discover the show. And so you can expand the number of people that benefit from this, or just share with a friend. Say, hey, I think you should listen to this episode. It starts with a lame excuse as to why they're covering a topic that's sort of on the edges, at least in terms of acceptability in a public setting, to mention those words. Nevertheless, I think it'd be valuable. All right, so that's it. Adrian, anything you want to add?
I'm all set, Eric. I really enjoyed this discussion with you today, and we'll be back next week with another episode of the Retirement Lifestyle Show. Thank you for all of our listeners and viewers for joining us today.